One stock that has dominated mind space over the last several weeks has been the Axis stock. And of course, this week it has been a star performer because of the big capital raising. The capital raising has been even bigger than what the market anticipated. And now I have with me, well, the star of the show, Shikha Sharma. Shikha, thank you very much for joining us. Well, that really is the first question. It's a big capital raising. The market was preparing for a 5% capital share issue. What we are getting is almost double. Can you tell us exactly some numbers as to what is the CET1, what is the Tier 1, what will it become after the capital raising, and how much of this is for growth, how much for loan loss?
As you know, Latha, in the past, we've typically raised capital with a 3-year cycle. And our intent has been to not come to the market too often, which is why the 3-year cycle. But we don't want to stock up with too much capital. So we try and stay with our best estimate of what we would need over a 3-year period. And that's pretty much what we have done this time as well. So assuming that growth does come back over the next 3 years, looking at how much we will need for growth, there's also the event of Ind AS what would happen during this period. So looking at how that might impact the need for higher provisions and some capital which may be required in a few of our subsidiaries which are currently in growth mode. Okay. So those are the 3 things that we have looked at while planning for capital. And again, our objective has been that we should try and keep CET1 at above 10.5. So given that we were hitting 10.95 and, you know, given the spate of capital issuances expected in the market, we thought it'd be a good time to go and raise capital.
So 10.95 becomes
so we have 10.95 in September. The raise is about 220. Given that we may use up some for growth, currently we would expect that maybe we will end up with about 12.75 CET1 at the end of the financial year.
Okay, fair enough. Now, how much of this is for growth? Would not some part be for loan loss because, you know, there is a big NPA as well to provide?
Yeah. The largest portion of this capital, internally generated plus raised, will certainly go for growth. And then we do expect that Ind AS could imply an increase in provisioning because of the definition of stage 2 and the requirement to provision that on an accelerated basis. So I think that will be the next bucket, and then it would be the subsidiaries. Difficult for me to give you an exact number on the Ind AS impact at this point because we are still waiting for complete clarity from RBI on how stage 2 is going to be defined.
You know, I heard numbers of 75 basis points of the extra capital will go for Ind AS. Is that a working number?
I think, you know, it could be anywhere around that number. So, as I said, difficult to predict, but it's not very off.
Okay. Well, before I come to, you know...
It also depends on what happens to markets, right? Because there's provisioning and there's MTM impact of the book. So, a lot of moving parts out there. Before I
ask your growth estimates, just a word on the investors. Bain Capital, after the conversion, gets 5.3%. Is it allowed to keep 5.3, or do you think the capital will, your whole equity will rise by then? Because RBI, you require RBI permission above 5%.
No, actually they would be just short of 5%. Okay. Even on a fully diluted basis.
Oh, right. So then no specific special permission.
No specific.
Nobody's asking for a seat on the board?
Typically, private equity investors do want a seat on the board. So we put that in our stock exchange notice that there is a right to get a seat on the board for Bain Capital.
Okay, okay. Well, now for the growth. You know, you did 16% loan growth this quarter.
Yeah.
Should we assume that as the you know, rate of growth, or can it be even better?
See, over the next 3 years, our estimation is that the consumption cycle will continue to do well, and some of large corporate credit growth, which has been very subdued because of the slow investment cycle, plus some of the credit demand going to the markets rather than to banks, I think that could change, and therefore we would expect corporate credit growth to go up. Plus, which I think a lot of people have talked about, but we do think that this whole demonetization and GST is going to result in a faster move from informal to formal. And to be honest, Latha, we are already seeing indications of that. So we are seeing some of that shift even in the numbers that we are seeing today. So I think if you take a 3 to 5 year view, some of that growth will come in as well. So I would expect that for a bank like ours, The baseline, we would expect growth to be about that 16% number. But we'll see how it goes.
Okay. Well,
we live in such an uncertain world, right?
Well, let's hope that we have toughed out and growth will be positive. But, let me come to the loan loss provision as well. As you say, you will have reserves also to, shore up your capital. How bad can it get? That 8,000 crore slippages was a nasty jar. Is that the peak? Should we see it receding from here on? And where do we end? 5.9 becomes what? 7?
So again, on the whole recognition issue, a couple of years ago, it was primarily based on record of payment. And as we move towards Ind AS, it's going to move to a different process where provisioning is going to look at inherent strength of accounts. So we have a big swing happening on that, and that is going to impact what happens in terms of provisioning as well, right? Having said that, I think we have said in the past that we think that the slippage numbers should begin to come down. And if you look at our numbers, they were coming down, except for the divergence issue which has come up in this quarter. So we would expect that post that you should see the numbers starting to come off, but we will see higher than long cycle slippages, I think, for a couple of quarters still, as things settle down.
No, why I'm asking you about a 7 or an 8% NPA is for two reasons. One, other lenders like ICICI peaked off at 8% or so it seems. As well, if I take your 27,000 crores GNPA and add the 15,000 crore, which is your double B, you come to about 40,000, which would be at the moment 10% of your book. So is that the peak? It doesn't get worse than that.
I would be very surprised if it gets to a 10% number, Latha. Because, yes, double B is not
is a good number to work with.
I don't want to commit to any number. You will hear it when we give our guidance for next year. But I can certainly tell you that we expect the gross slippage numbers to slowly come off. And by the second half of FY19 is when we would hope that we should get back to a long cycle credit cost type of number. So the next couple of quarters could still see elevated slippages, and then the second half of 19 is when we expect a long cycle average. And our long cycle average is about 1% credit cost.
What is causing this divergence between the Reserve Bank and at least private sector banks? Is it more optimism, or is it that Reserve Bank is preparing for Ind AS?
So I think Reserve, as I mentioned earlier, the recognition process for banks till a couple of years ago was purely based on record of payment. And that's what we knew, and that's how we disclosed it. But over the last few quarters, ever since AQR, RBI has access to a lot more data of the entire banking system, and they're using that, I think, to look at flows and try and assess inherent weakness. And I think, yes, preparing banks with a more fortified balance sheet, and that has resulted in accelerated recognition in some cases. So if, at the point of AQR, we had a very small divergence. But subsequent to that, I think with some of this data across banks that RBI is using, we have had divergence numbers last year and this year again. This year, as we've pointed out, only 6% of the total banking exposure to the companies which were identified during the divergence is NPA. So it's not like, there was reports on what were we trying to do. I just want to say that it wasn't that we were trying to do something. I think RBI as a regulator is looking at fortifying balance sheets, accelerating provision, and they've told us to downgrade some of these assets, and we have done that. Hopefully, some of these will see recovery and upgrade over the coming quarters.
Well, besides steel, which was the big shocker across banks, there is, of course, power and telecom. What is your exposure to telecom? Are any of the, if you knock out the top 3 telecom players, Aircel, Arcom, are all now looking vulnerable? What is your exposure to those?
Our funded exposure is largely to the high quality names here.
So we shouldn't expect...
we would hope not to see any shocks
Too much of shock from telecom. That's telecom. How about power? How much should we expect? What's your exposure, and how much do you think can cause stress?
So we have currently standard exposure of about 17,000 crores in power, and about 30% of it is BB and below.
Okay. So that
gives you some size of what could be vulnerability.
Yeah. All right. Right. Let me take a break on this note. We've spoken a lot about stress. Let's now speak about how we are going to use the capital. Are we going to see a big technological change in access? All those questions to Shikha Sharma in a minute after this break.